You articulate why it's bad for wannabe investors and indeed for future growth and financial benefits to many, Eric. But why is this happening from your perspective?
Well, it's happening mostly due to regulations. That's the number one factor. Number two factor is that companies are choosing to stay private longer because there's more private capital. It's a bit of a conundrum because obviously all of this private capital is expecting an exit at some point, which is likely to be the public markets. So we used to have 8,000 public companies back in the 90s. We are down to less than 4,000. At this pace, we'll be down to 2,000 in another 20 years. 2,000 is about the size of the London Stock Exchange, which, by the way, went from 4,000 to 2,000. So our stock exchanges are shrinking, not in terms of valuations, but in terms of the number of public companies, meaning that the remaining companies have higher and higher market capitalizations, and it's very difficult for young, innovative, growing companies to go public.
Can we think about this, Eric, through the lens of a case study, if you don't mind? I think about Elon Musk, Inc. You know, he's documented the challenges of being a public company CEO of Tesla. And if you, by comparison, look at his private companies, SpaceX, XAI, the company formerly known as Twitter, many would argue that he's able to innovate with more freedom because he's free of the responsibility or scrutiny or even the transparency required of being a public company. What would your response be to that case study and that line of argument?
I would say that Elon is pretty distinct and remarkable by himself, and that he's been able to raise billions of dollars in the private market for his companies and stay private a lot longer. This is not within the reach of most private companies. Most private companies are able to raise, in the tens of millions or hundreds of millions at most. But to have access to $1 billion, $2 billion in capitalization, you need the public market for this. So when Elon's companies go public, they're already pretty substantial companies, and so that's not the norm. The norm, what we're looking for, is the ability to have public companies being capitalized at around $1 to $5 billion. That's where there is almost no IPOs, and this is kind of the point of entry. Let's take the example of NVIDIA. NVIDIA went public in the late 1990s at a market cap of about $600 million. Let's say that's about $1 billion in today's money. That company now is worth almost $3 trillion. So a remarkable rise. And a lot of the public shareholders, the people who were able to buy those shares in the early days, have become, if they kept them, have become very, very rich. Yeah. That's the kind of momentum that we're looking for.
But therefore, if it's regulation that stifled it, is it less regulation that's needed? And therefore, how do you protect an investor base with less regulation?
Well, it's going to be judicious regulation. The tipping point really was the Sarbanes-Oxley Act of 2002. A lot of smaller public companies were forced to either delist or merge or go private, given the burdens imposed by SOX, by that particular act. So this, in my mind, this needs to be reviewed. Do we really need all of these controls, all these internal controls? We're assuming we're kind of assuming that people who go public have something to hide, have bad intentions of sorts. We need to go back to a place where we allowed
Eric,
capitalism. Yes.
Eric, I just would push back on that slightly. I mean, one reason that it's such a privilege to host this show with Caroline is that we come across all kinds of founders who dream of taking their technology startup public because of the prestige or because it gives their staff liquidity, who may be long-serving. In many instances, that's the dream and it's still intact. You're an investor and you're part of this ecosystem. Do you not recognize that still being a part of the dream?
Very much so. It's in some cases almost the only dream, right? That's your exit. So let's take a typical company in a private portfolio such as mine. Company does $100 million in annual recurring revenues. has a grows 30 to 50% a year, has EBITDA of about $20 million. Again, I'm using a general case. And they want to go public. So what's going to happen? The cost of going public is going to cost them $10 to $15 million a year, right? So that's over half of their EBITDA. So suddenly the valuation that they might command in the public market is way less than it should be as a result of this. So there's plenty of companies in that situation who would like to go public. They've been in business for 10 years or more. Their employees need that liquidity for their own equity. But it's not really possible for them to do so.